For most people, the thought of the Internal Revenue Service, or IRS, brings a certain level of unease. It's the government agency responsible for collecting taxes, a task that few enjoy. But there is one specific action from the IRS that strikes a deeper chord of fear than almost any other. It's the idea of an audit. The very word can conjure images of stern-faced agents, mountains of paperwork, and intense scrutiny of your personal finances. This fear is widespread and deeply ingrained in our culture, often portrayed in movies and television as a sign that someone is in serious trouble with the government. It represents a loss of privacy and a potential financial blow. This anxiety isn't entirely without reason. An IRS audit is an official review of your tax return to ensure that the information you reported is accurate and that you have paid the correct amount of tax. The process can be time-consuming and stressful, requiring you to produce detailed records and justify every financial decision you made during the tax year in question. The potential outcomes can range from a simple no-change letter to a notice that you owe more taxes, plus penalties and interest. This uncertainty about the outcome is a major source of the dread associated with receiving that official letter in the mail. The fear of an audit can affect how people approach their taxes each year. Some become overly cautious, perhaps missing out on legitimate deductions and credits they are entitled to claim, simply because they are afraid of attracting unwanted attention. Others might feel a sense of panic when filing, worried that a small, honest mistake could trigger a full-blown investigation into their financial life. This fear can lead to a great deal of stress during tax season, turning what should be a routine civic duty into a nerve-wracking ordeal. Understanding the process is the first step toward reducing this anxiety and taking control. Ultimately, the power the IRS holds over our financial lives is significant, and an audit is the most direct way that power can be exercised. It's a formal examination where the burden of proof is on you, the taxpayer, to validate the numbers you submitted. The fear comes from the unknown. Why was I chosen? What are they looking for? What will happen if they find something wrong? These questions can feel overwhelming, but they don't have to be. By learning more about how the system actually works, you can replace that fear with a sense of preparedness and confidence in your financial reporting. While the idea of an audit can be intimidating, it is important to remember that it is a standard part of our tax system. The IRS cannot possibly review every single tax return filed each year. There are simply too many. Instead, it uses a systematic process to select a small percentage of returns for closer examination. This selection is not always a sign that you have done something wrong. Sometimes returns are chosen completely at random. The purpose of this guide is to pull back the curtain on this mysterious process and give you a clear understanding of how the IRS decides who gets audited. By demystifying the audit selection process, we can transform fear into empowerment. When you know what the IRS looks for, you can be more mindful when preparing your own tax return. This video will walk you through the inner workings of the system, step by step. We will explore the computer programs that flag returns, the common red flags that increase your chances of being selected, and the role that third-party information plays in the process. This knowledge is not about finding ways to cheat the system. It's about understanding the rules of the game so you can play it correctly and confidently. This is not just about avoiding an audit. It's about building good financial habits that will serve you well in the long run. We will provide practical, actionable advice on how to protect yourself. This includes tips for meticulous record keeping, guidance on reporting your income and deductions accurately, and strategies for ensuring your tax return is neat, complete, and easy for the IRS to process. These steps not only lower your audit risk, but also put you in a strong position to defend your return if you are ever selected for a review. Preparation is your best defense. The goal here is to equip you with the information you need to navigate the tax system without fear. An audit does not have to be a catastrophe. For the well-prepared taxpayer, it is simply a request for verification. By the end of this guide, you will understand the factors that trigger audits, know how to prepare a return that is less likely to be flagged, and be aware of the exact steps to take if you do receive that dreaded letter from the IRS. You will be able to approach your taxes with a sense of calm, knowing that you are in control of your financial information and prepared for any questions that may arise. The IRS uses a sophisticated computer program as the primary gatekeeper in its audit selection process. This automated system analyzes tax returns to spot anomalies. The main tool is the discriminant information function, or diff, a complex formula that assigns a score to each return. A higher diff score indicates a higher probability of errors or underreported taxes. The diff program compares your return to norms derived from audited returns, looking for deviations. For instance, large charitable deductions relative to your income can increase your score. A high diff score flags your return for further review by a human, who determines if the suspicion is justified. The exact diff formula is a closely guarded secret, but it evaluates relationships between items on your return. It looks at deductions, income types, and business expenses. Your goal is to fit comfortably within expected norms. While the DIF computer program is the most common method, it is by no means the only one. The IRS employs other strategies to identify potential non-compliance. One method involves related examinations. If your business partner, investor, or even an ex-spouse is audited, your return might be pulled for review as well. Another source of audits comes from public information and tips. The IRS has been known to initiate examinations based on media reports that suggests a taxpayer's lifestyle does not match their reported income. Furthermore, the IRS operates a whistleblower program that rewards individuals who report tax evasion. Sometimes you might be selected for an audit through sheer random chance via the National Research Program, NRP. Finally, your audit risk can be influenced by your participation in specific projects or compliance studies run by the IRS, focusing on particular industries or transactions. Beyond automated systems, many audits are triggered by information matching. The IRS cross-references income reporting forms like W-2S and 1099-S against your tax return. Mismatches are flagged. These information matching audits, called correspondence audits, are handled through the mail with notices like a CP 2000 letter. IRS employees can also manually select returns for audit if something seems unusual. Claims that seem outlandish or returns that are difficult to read can attract attention. Certain claims require a higher level of scrutiny and may be manually reviewed. This human element adds judgment to the selection process. Say, one factor that can attract the IRS is reporting a very high income. The more money you make, the more likely you are to be audited. High-income taxpayers have more complex financial situations, with more opportunities for errors or aggressive tax planning. Claiming unusually large deductions or credits relative to your reported income is a classic audit trigger. If your charitable contributions, medical expenses, or business deductions are disproportionately large, it will raise a red flag. Claiming 100% business use of a vehicle frequently draws scrutiny. Another area that can cause trouble is the home office deduction. However, the rules for claiming it are very strict, and claiming a suspiciously large portion of your home as an office can trigger an audit. If you are self-employed, a freelancer, or a small business owner who files a Schedule C, your chances of being audited increase significantly. The reason for this is pretty simple: opportunity. Unlike a traditional employee whose income is reported by their employer on a Form W-2, self-employed individuals are responsible for tracking and reporting all of their own income and expenses. This structure presents more opportunities for underreporting income or overstating deductions, whether by mistake or intentionally. The IRS is well aware of this and therefore pays closer attention to Schedule C filers. A major red flag on a Schedule C is reporting business losses year after year. While it's common for a new business to lose money in its first couple of years, the IRS expects a for-profit enterprise to eventually become profitable. If you consistently report losses for 3 or more years out of 5, the IRS may suspect that your business is actually a hobby. Under the hobby loss rule, you can't deduct expenses that exceed the income generated by the activity. An audit in this case would aim to reclassify your business as a hobby, disallowing all the losses you claim to offset other income. Cash-based businesses are also a prime target for IRS audits. Businesses like restaurants, bars, hair salons, car washes, and certain contracting services often deal heavily in cash transactions. Cash is much harder to trace than electronic payments, creating a greater temptation and opportunity to underreport income. The IRS has specific audit techniques and programs designed to scrutinize these types of businesses. They might analyze your bank deposits, compare your reported sales to industry averages, or even use indirect methods to estimate your true income based on your business's known costs and typical profit margins. Operating a cash-intensive business requires meticulous and honest bookkeeping. Finally, the way you classify people who work for you can also trigger an audit. A common issue is the misclassification of employees as independent contractors. Businesses can save a significant amount of money on payroll taxes, unemployment insurance, and benefits by paying workers as contractors, issuing a Form 1099 instead of as employees, issuing a Form W-2. The IRS has strict guidelines for determining a worker's status. If they suspect you are misclassifying employees to avoid paying your share of taxes, they may initiate an employment tax audit, which can be particularly invasive and costly if you are found to be non-compliant. Sometimes, what triggers an audit has more to do with your overall financial activities. Engaging in large transactions can draw IRS attention, including real estate deals, complex investments, or foreign bank accounts. Failing to file an FBAR for overseas assets almost certainly invites scrutiny. Cryptocurrency is another area of focus. The IRS asks about digital assets on Form 1040 and receives information from crypto exchanges. Incorrect answers or unreported gains can trigger an audit. Amending a tax return can also increase audit risk, especially if it requests a large refund or changes income significantly. Be prepared to justify any changes. Finally, relationships matter. If a business partner is audited, your return may be reviewed. Association with high-risk entities can increase your chances of scrutiny. The single most effective way to lower your risk of an IRS audit is to ensure the numbers on your tax return are completely accurate. This starts with reporting all of your income. Before you file, gather all of your income documents, including every W-2, 1099 NEC, 1099 INT, and 1099-B. Carefully add up all these sources of income and make sure the total on your tax return matches the total the IRS already knows about. Accuracy is just as crucial when it comes to your deductions and credits. Double-check all of your calculations before you file. Using reputable tax software is highly recommended. Taking a few extra minutes to verify your numbers is a small investment of time that can save you a major headache later on. Your name and social security number must exactly match the information on file. Precision and accuracy demonstrate care and leave little room for the IRS to question your filing. While the substance of your tax return is most important, its presentation also matters. A clean, well-organized return gives the impression of a careful taxpayer, which can work in your favor. For most taxpayers, filing electronically is the best option. E-filing reduces errors and ensures all necessary forms are included. If your financial situation is complex, seek professional help. A qualified tax professional understands the tax code and can help you navigate complex issues. Their expertise ensures your return is prepared correctly, and that you claim all entitled deductions and credits. The IRS requires tax preparers to have a Preparer Tax Identification Number, or PTIN. Be wary of any preparer who promises unusually large refunds, or suggests you claim deductions you don't qualify for. Good records are your best defense in an audit. The IRS expects you to prove every number on your return. Keep receipts, bank statements, and written acknowledgments for deductions. Don't rely on memory or estimates. Organize records by category and digitize them for easy access. A shoebox of receipts won't cut it. Use folders, spreadsheets, or apps to stay organized year-round. Hold on to tax documents for at least 7 years, since the IRS can audit returns up to 6 years old in some cases. With solid records, an audit becomes a paperwork exercise, not a crisis. Common sense is as important as documentation. Don't make claims that seem too good to be true. Only deduct what you can clearly prove. Don't exaggerate business use of your car or home office. The IRS looks for red flags like 100% business use or repeated small losses on a side business. Run your business to make a profit, not just to claim deductions. Before filing, ask yourself if your return would make sense to an outsider. Honest, reasonable claims keep you off the IRS's radar. Preparation starts with a reliable record-keeping habit, not a last-minute scramble. Use a system, physical or digital, that you'll actually maintain, with clear categories for income and expenses. Keep original receipts, not just credit card statements, and jot down business purposes on them. For donations over $250, get a written acknowledgement from the charity. Store all tax documents for at least 7 years to cover the IRS's audit window. Consistent, organized records turn audits into routine checks. Honest reporting is the backbone of your tax return. Report all income, even side gigs, and don't blur the line between business and personal expenses. Only deduct what you can prove. Never round up or guess at numbers. Auditors spot perfect or inflated figures. Claim only what your records support. Respect the tax laws and view compliance as a civic duty, not a loophole hunt. Filing with integrity protects you and reflects your character. Digital tools make record-keeping easier and more secure than ever. Scan and store receipts digitally. Use apps to track expenses in real time. Cloud storage keeps your records safe and accessible, and sharing with your tax preparer is simple. Download bank and credit card statements for backup and easy sorting. Separate business and personal finances with dedicated accounts and cards. Embrace technology to stay organized and audit-ready. Receiving an official envelope from the IRS can be alarming, but the most important thing is to stay calm. An audit isn't an accusation, just a request for information. Read the notice carefully to understand which tax year and items are being questioned. Then gather all relevant documents to support your return. Organized records make this easier. Finally, consider seeking professional help from a qualified tax expert. They understand the process, can represent you, and ensure your rights are protected. When interacting with the IRS, whether by mail or in person, be professional and courteous. Answer questions specifically, without volunteering extra information. The audit is limited to the tax year and items listed in the initial notice. For correspondence audits, send copies, not originals, via certified mail with return receipt. For office or field audits, the same principles apply. It is highly recommended that you have your tax professional handle the meeting and answer questions honestly and briefly. After the review, you'll receive the findings. There are 3 possible outcomes: no change, agreed, or disagreed. If you disagree, you have the right to appeal. We've explored the IRS and the audit process. Understanding the system, the importance of matching information, and reasonableness in your claims builds confidence. Accuracy, thorough documentation, and honesty are your best defense. An audit is a request for proof. Good habits like leveraging technology and seeking professional help create a clear financial footprint. If you receive an IRS letter, don't panic. Gather documents and consider professional representation. You have rights, including representation and appeal. Shift your perspective. See tax season as a chance to showcase sound financial practices. By being honest, organized, and informed, you minimize risk and control your financial narrative. File with peace of mind, knowing you've done everything correctly.